Good morning, attendees, and thank you very much for joining today's webinar, Navigating Natural and Financial Storms, Insurance Fundamentals. I just want to make sure, can everybody clearly hear me from the speaker side?
I can hear you.
Thank you. So we are welcomed here today with attendees from the financial sector, organized agriculture, and farmers who have a direct interest in climatic impacts on agriculture and insurance, with options available to mitigate against these risks. So the purpose of today's webinar will specifically focus on the impact of the El Nino on the agricultural sector and explores how self-insurance can play a vital role in mitigating the financial risk associated with this climatic phenomenon. Join us as we delve into the unique challenges faced by farmers and agricultural businesses and discover practical strategies to safeguard against the disruptions caused by El Nino events. I am Andrea Camphor. I'm the Risk and Disaster Manager at Agri SA, specifically looking after the needs of the agricultural sector when disaster strikes. Funding to be made available through the Agri SA Disaster Relief Foundation and coordinating disaster responses across provinces and across industries. Before I introduce the speakers to you, just a few quick house rules. We ask that all microphones be turned off. You are welcome any questions that you have in the question answer box or the chat box. We will have a question answer session after the presentations. The webinar is recorded and will be made available to the attendees of the event, as well as Agri SA social media platforms such as YouTube. The webinar is accredited and a certificate will after the webinar to earn 1.5 CPD hours. This is only applicable to the financial industry. So you will receive it within 1 week after the webinar. And if you have not received your certificate, please contact us. We have noticed that with the previous webinar that there might be glitches from time to time, or it might end up in your spam box. So we will assist where we can. Any social media interacting on the webinar today, may you kindly use the hashtag Navigating Nature and Insurance. We will also put that for you on the chat box. So should we not answer all the questions raised in the chat box today, we will circulate the answers after the event to the attendees. So first up, Prof. Willem Landman, are you online? Would you please switch on your camera? Now is Prof. Willem online? Oh, yes. Good morning. So you might have noticed in the news and reports issued by the South African Weather Service the possibility of an El Nino occurrence expected later this year. And the South African Weather Service recently reported that the El Nino Southern Oscillation is currently transitioning into a warmer El Nino-like conditions, moving into an El Nino state, which is, according to the latest predictions, expected to persist through most of the summer months. I would start off by introducing the first speaker for today's webinar, Prof. Willem Landman from the University of Pretoria. Prof. Willem Landman will set the scene for us to understand what is meant by this weather occurrence and the impact on agriculture. Prof. Landman has been a meteorologist for more than 3 decades. He's currently a professor in meteorology at the University of Pretoria, where he teaches undergrad and postgraduate courses in meteorology and supervises master's and PhD students on weather and climate modeling topics. He focuses on the development and testing of prediction models for sub-seasonal to seasonal and seasonal to annual timescales. He is recognized for being central to the national seasonal forecasting in South Africa. His work has impacted on specific applications of seasonal forecasting for hydrology, agriculture, and health in Southern Africa. Welcome you this morning. You have the floor. Thank you very much.
So I suppose you've heard my introduction. I acknowledge the contributions from my next door neighbor Emma Archer, and my colleagues from the University of Cape Town, Mark Tadros and Peter Johnston. Okay, next slide. First slide. It shows El Nino and La Nina events in terms of sea temperatures and also the associated deep convection when we have such events. So what happens during El Nino events is that the sea temperatures over the Central Pacific Ocean basin warms up considerably. When we have very strong El Nino events, the sea temperatures over that Central Pacific Ocean basin can warm up to be about 32 degrees Celsius. So we have high temperatures and also an abundance of moisture. It's the Pacific Ocean, which leads to these deep convection patterns to develop. And once these deep convective patterns are strongly developed, they start to influence global circulation patterns. When we have an El Nino, the sea temperatures are anomalously warm, and we see the shifting of the deep convective patterns towards Central Pacific Ocean. And when we have a La Nina events, we see the sea temperatures to become anomalously cool, and you see the shifting of the deep convective patterns away towards the west. Like I've explained, such a configuration influences global circulation patterns. So El Nino and La Nina events are specifically used to refer to the occurrence of such a weather and weather / atmosphere and ocean events. So it's not a word for drought, or a word, La Nina is not a word for good rainfall. It's something that happens over the Central Pacific Ocean. Excuse me. Next slide. So before we start making forecasts, whether or not our forecast models are on track. On the left, you see a current situation of a 7-day average centered around the 19th of July that shows sea surface temperature anomalies that are above average, which is indicative of the warming that we expected to happen, as I will explain in the next slide when we show the forecasts. So we are already observing the sea temperatures to be anomalously warm, and it's rather over a larger area. It's almost the entire Pacific Ocean basin at the moment. The frame in the middle is showing some boxes of interest for ocean and atmosphere modelers, and the Nino 1 and 2 box is the box just west of Peru. And we have Nino 3, Nino 4, and the box that we are most interested in, Nino 3.4, that box has the ability to best indicate the intensity of El Nino and La Nina events, and that box, the sea temperatures in that box, is also strongly linked to South African summer rainfall. The frames on the right shows the evolution of the sea surface temperatures over these various boxes shown in the middle. And the blue shows where the sea temperature anomalies have been anomalously cool. This is an association with the previous season's La Nina event. And take note that we had 3 consecutive La Nina events. That really doesn't happen a lot. It has happened in the past. I'll show an example later on where it has actually happened. But now we are headed towards a warming of the sea temperatures. And this is what the orange area is showing us. Take note that this evolution from cool towards warm takes place over several months. It takes place over a rather long time. So you can't expect, when we are in the development phase of an El Nino, that it will suddenly change towards La Nina. So there's too much inertia in the development of these sea surface temperature anomalies that we will suddenly observe an abrupt change. It simply doesn't happen. So when we get towards the middle of the summer period, in our case is December, January, and February, this is then when we also experience the most intense phase of El Nino and La Nina events. But this shows that we are clearly headed towards a warming. Next slide. Now, how good are we at predicting this warming or cooling? So here I have on the left showing forecasts as well as observations of sea surface temperature anomalies over that special Nino 3.4 box made for the month of January, with lead times up to 6 months ahead. And obviously you can clearly see the strong correlation between observations and forecasts. And that shows that when we are talking about El Nino and La Nina events, that we can really well ahead of time start to make predictions on whether or not there will be an El Nino or La Nina. Now, can we do with the same lead time forecasts that are useful for rainfall over Southern Africa? Unfortunately not. So we need to get much closer to the summer period before we can make forecasts that have some skill in predicting rainfall changes over the summer period. That has to normally happen by about August, September. The map on the right is an example of an operational product that we use to make the forecast of sea temperatures during the month of December for the 97-98 El Nino event. And what I'd like to show you is how well the models captured the intensity of that event. In excess of 3 degrees Celsius is the size of the anomalies. And also, this is a nice example to show you to what extent the warming happens over the Central Pacific Ocean. That area is about as long as the length of South America. It's a really, really enormous area. And so you can expect that when we have such strong anomalies happening over such a big area, why it will be able to influence global circulation patterns. The map on the left shows how good we are in predicting sea temperatures globally. And where we see blue is actually showing where the forecasts don't work. Where we see red is where the forecasts work. And you can see the forecasts work primarily over the tropics and maybe some of the subtropics, not really over the polar areas or the mid-latitudes. And you also can see from that map is that the largest red, dark red area happens to be over the Central Pacific Ocean basin. This is then showing us that the area of ENSO, where we find El Nino and La Nina events, that area is highly predictable compared to other areas of the planet. In terms of predicting anything on seasonal timescales, if it's rainfall or temperature or whatever, the prediction of ENSO events is by far the most skillful thing to do. So I'd like to go back to the map on the right so that you can just train your eyes over the Central Pacific Ocean. I want you to focus on that area because the next slide will show some of the forecasts over that particular area. Okay, this slide, this was supposed to be flying in. Anyway, so what this is supposed to show is different stages in the forecast process, forecast that we started to issue in as early as March, and the latest forecast, the one on the right, shows forecast that we initialized in July. So this is a forecast actually made about 2 weeks ago that shows the extent of the sea surface temperature anomalies for the coming season. I'd like to draw your attention to the tiny map on the bottom right. You'll see this is the forecast that we produced in July for the December, January, February season. And you can clearly see the extent of the warming. 2 to 2.5 degrees Celsius. So from the forecasts that we have produced, we see that there's a very good chance that the sea temperature anomalies that we have already observed to have become warm to continue in order and then lead to a very well established El Nino event. Next slide. So what do we have here? This is an example of the 97-98 El Nino event. The black line shows the sea temperature anomalies. This time it's over the Niño 4 area. Shows the observed anomalies for that particular event. And those plumes, the red and the green, blue, orange, purple, etc., those are forecasts produced by a very sophisticated, fully coupled ocean atmosphere climate model that only the really big centers internationally can have the computing capabilities to run. And so the forecasts are showing plumes. That shows a range of possible sea temperature evolution. And like I've said before, El Nino and La Nina events are the most predictable events on the seasonal timescale on the planet. And here we see clear example why we also need to look at what the possible range of forecasts could be, and then hope to see that the actual observation falls within this range. So this is an example of a type of a probabilistic forecast. What are the chances of a particular anomaly being reached over that Central Pacific Ocean basin? So if we are taking into consideration that Enzo is very predictable, we also see from this example that we have to make statements regarding uncertainties in the forecast. One of the ways that we love to do this is through a probabilistic forecast statement. Next slide. Again, this is supposed to fly in, so I'm going to go directly to the frame on the bottom right that shows the forecast that we issued for the on the 14th of July. The yellow gives probabilities of an El Nino event developing, the green of an Enzo neutral event developing, and the blue the chance of a La Nina event. So for all practical purposes, those probabilities associated with La Nina could be made 0. So there's showing the likelihood from our forecast system that we run at University of Pretoria. It shows a very strong probability that we are indeed going towards an El Nino during the 23-24 season. Next slide. Yeah, forecasts from other centers. The graph on the left shows forecasts from a range of different forecast centers, products, and the University of Pretoria's forecast is also there somewhere. So we contribute to this so-called forecast plume, and from the forecast plume, a probabilistic statement is developed, and this is what you see on the right, that shows the forecast produced by the International Research Institute for Climate and Society that shows overwhelming probabilities associated with the development of an El Nino. And what this forecast currently tells us is this will last throughout the entire Southern African summer rainfall period. Next slide. Here's our own forecast that also shows, in addition to the probabilities, the range of possible sea temperature anomalies, again for this magical Nino 3.4 area. On the left, you see a forecast that I issued in April that was already showing that we are headed towards a moderate to strong event. And the latest forecast issued in July is continuing in the same vein. It says that there's we are still making the statement that we are going towards moderate to maybe even a strong El Nino event. The 97, 98, as well as the 2015, 16 events that also, especially the last one, caused region-wide drought conditions. Those were classified as very strong events. So the expectation is that this current event will not be as strong as the 2015-16 event. Next slide. So to summarize, the sea temperatures over the Central Pacific Ocean is warming. I've demonstrated how such a warming is predictable many, many months ahead. 6 months is actually a long lead. We have started to predict the current expectation of an El Nino event since earlier this year. I tried to show an example of a forecast produced in March already. The models that we look at globally, they all are, for the most part, showing El Nino is coming. There's an El Nino, very little doubt about that. And at the moment, it seems it will be moderate to maybe even strong, but not a very strong event. So let's go on to the next half of my talk. Next slide, please. And this shows an example of our efforts in trying to assist a farmer in decision making. So what we have here is a whole bunch of different time series, and I hope it's not too confusing. So I'm going to explain each of them in turn. So what we first see is a nice purple line. So those the purple line is showing forecasts of a model that we've developed for this farmer in predicting this farmer's dry land crop yield at the end of the season. When we see LA at a particular year, it shows a La Nina, when a La Nina season occurred. When you see EL, it's when an El Nino season occurred. The blue is what actually was observed as the yield. So I should just also mention that I'm not talking here about tons per hectare we are talking about a yield index. So what it actually is just a normalized value of the yield at that particular farm. The thin blue line shows the rainfall that happened over that farm in terms, again, of its standardized value, so that all these lines can fit onto the same graph. This is really the reason why I did this, as well as the maximum temperatures. And so you can see that there is, in fact, quite a good correlation between the rainfall during the summer season, and that's this period I looked at was for the October through March season for both rainfall and for maximum temperatures, that the correlation between rainfall and the yield is 0.6, and the correlation between maximum temperature and yield is minus about 0.6. So there's quite a strong correlation, but sometimes the years are missed. That we predicted a particular outcome and it didn't happen. And for this talk, I'm going to pay special attention to this unfortunate period when we had our previous example of 3 consecutive La Nina. As you show right in the middle of the graph there, it's
Prof, are you still there? I'm not sure if my colleagues can hear.
I cannot hear. Prof.
Just give him a moment. I think he might have loose sound.
Hello?
Prof, jy
Hello?
is terug? Yes, ons hoor jou.
Okay.
You can proceed. Thanks.
Okay. Should I go back a slide or can I just continue?
You can just continue from this one.
Normal yield, but the observation, what was actually taken off the left, low. So there's a 2-category miss. That there's actually there's good skill. If you look at the correlation, that the skill calculate, or the correlation between forecast and observed for the 1990 to 98 season is 0.73, and again for the period 2001 to 2009 is 0.79, are both highly significant correlations. But for the period in between, the forecasts really messed up. And so the question that we asked is, how could such a mishap affect the farmer financially? Because we see evidence that there's something in this model. It does get a lot of the seasons right. And a strong driver is rainfall, and we're actually not too bad in predicting. But then this middle part, we had a big failure. So how does that influence the farmer's finances? Going on to the next slide. So further verification before we ask the question of how such a terrible forecast will influence the farmer's finances, just a summary. So the pie chart on the top shows the forecast. So what has happened in the time series, that when we have an El Nino, we see that for the most part, the yield is below average. When we have a La Nina, for the most part, the yield is above average. When you have a neutral condition, for the most part, the yield is in the normal category. However, when you look at the observed, the pie charts look quite different, not so much for the El Nino case. So we still get forecasts, observations of below normal yields when there's an El Nino. But for La Nina, we actually got a quarter of the time. We also had below normal yield. So there's a bit of a mismatch between observed and forecasts when you talk about the outcomes during particular ENSO, whether it is El Nino or La Nina events. Next slide. The next slide is a bit complicated. I'm not going to go into any detail here, but this is the kind of work that we do in order to find out whether or not the forecast system that we have developed is any good. The two graphs on the left is a so-called reliability diagram or an attributes diagram. And what you want to see is the thick blue or the thick red line falling right on top of the thin diagonal line of perfect reliability. What that actually means is that if we make a forecast for a particular probability to occur for a higher yield or low yield, that probability matches the frequency with which these low yields or high yields have occurred over the verification period. This is not too dissimilar to what we have found for rainfall forecasts. So there's some similarity between the yield forecasts and the rainfall forecasts. But we have really been struggling to get forecast users to use forecasts that we issue and also consider the skill levels associated with the forecasts. And so we've just written a recent paper that we've published in Water SA where we link one of the forecasts verification metrics, that is also shown on the left, the ROC score with correlation. But we also investigated how we can actually produce evidence that forecasts work by looking at how profits are being made. But we are not economists. We are climate modelers. So we tried something, and what this next few slides is going to try to demonstrate what will happen if we tie some sort of a financial decision process to the forecasts produced for this particular farmer. Next slide. So what are we doing? We're looking at cumulative profits. So we're looking at these values evaluated over 3 categories of above normal yield, near normal yield, and below normal yield. And we tie some investment to this, but the investment that we tie is then also linked to how skillful the forecasts are being produced. And so we then calculate some profits that the farmer can make. This is kind of a process of gambling. It's what we will show is on the next slide. Don't go there yet. What happens if we make a certain investment, a profit is being made, and we take the entire amount and we plow it into the next year. This is when we invest everything into the next year's forecasts, what implications that may have. Then what may happen if we only invest a fraction of that amount, and what may happen if we invest a fixed amount. And so this is the next slide, please. So first of all, there are 3 lines that I show here on the graph on the left are lines that show the cumulative profits. First of all, I'd like to draw your attention to the, irrespective of whether we are looking at a 100% use of our profits, or if we are only using a fraction that we gamble, 50%, or using a fixed amount, it takes a few years for us to notice an accumulation of profits. When we gamble a lot of our investment, we use 100% of the profits. You can see what the blue line looks like. So in those years where we made fantastic forecasts, the farmer can become really rich. But look what happens as a consequence of the failed 1999 and 2000 forecasts. That accumulation of profits to some extent get wiped out, and it kind of never recovers, even though we have seen that in the period, the last few years of the forecast, that the forecast is actually very well correlated to the observation. So because of that terrible year where we said there's a very large probability, in fact, if you look at the values that I put there on the top left, there's an 85% chance that we will have a high yield, and we actually found that it was below normal yield. That had a massive financial impact. The orange line shows that if we only take half the profits, so we see a much more modest increase in accumulation of profits. The unfortunate events of during those 3 La Nina seasons did have an impact, but not nearly as severe than what we have if we only invest a fixed amount. You can see that had the least impact. So what we're showing here again is if we use forecasts, there's profits to be made, but it doesn't happen overnight. It takes a few years. Forecasts that work out really badly, in the case of missing it by 2 categories, can have huge financial impact if you base your farming decisions entirely only on what the forecasts tell you. If you are more conservative and you only look at the 50% of the investment of investing 50% of your profits into the next year, it's not so bad. But I think the best outcome is to kind of have a fixed amount that you use in your farming decision. Exactly how this is done as a climate modeler, I'm not entirely sure. But what I'm trying to demonstrate here is instead of just showing to a farmer what is the correlation or what is the rock score or what does the attributes diagram look like, we try to give some link with financial gain, and maybe that is more able to talk to a farmer. And already we see here, don't use the forecast as is, and don't use any other information to make a decision on what your farming should be, how it should be handled this coming year. You should be, first of all, more conservative. And this example, this may be just for this particular example, we're saying that the safest way is to invest a certain amount, a fixed amount each year. Let's go to the next slide. This summary, it's a summary slide of what we have actually learned. So far, we've seen that if we want to see true benefit in using such forecasts, it doesn't happen in just one season. It may take a few years for us to see the real benefit. For most of the time, forecasts for rainfall and as well as for crop yield, they show when there's a rain coming, we seem to be predicting good yields, and when there's no rain, it's a consequence probably of El Nino, we see low yields, but it's not something that we always see in the observations as well. So there's a bit of a mismatch there, but still the forecast models are not doing a bad job. In fact, this is not something I presented here, but we have actually strong evidence to show that using the forecast models is more beneficial than just not using the forecast at all or just guessing. Forecast models have the benefit, and so we've also demonstrated how they could be beneficial in the accumulation of profits idea. So, and then the last slide, the last bullet here, the investing the fraction of the initial investment lessens the impact of decisions based on where the forecasts go really badly. Well, my talk cannot be complete without showing what the forecast for rainfall is for the coming season. So let's go to my last slide that shows that. So on the left, you see forecasts in terms of the likelihood of it being wet, the blue, the likelihood of it being dry, the red and orange, for the October, November, December season, for the forecast that I issued this month, about a week or so ago. You can see that over Southern Africa, there's a large area of red and blue. So let's go to the maps right next to that. So those are the 2 maps right in the middle of the slide. They show skill. So what this skill is telling us, What is our ability to discriminate wet seasons from the rest of the seasons? That is what the top panel in the middle shows. The bottom panel in the middle shows our ability to differentiate or to discriminate droughts from the rest of the season. Okay, so if you look at the red forecast and the yellow of the below normal rock area, we see that there's an agreement. So there's rock scores that are not blue. When you see rock scores being blue, it means the forecast don't work. We see then that where the forecasts are for below normal, we have seen in the past that such forecasts have skill, so we can believe the forecast. When we look at the area where the forecast is for wet conditions and go to the map that shows the rock scores for above normal, we see blue, which means the forecasts have been terrible at predicting wet conditions for October, November, December at this particular lead time. So what this tells you is that we have a forecast, we have a set of verification statistics, and together they tell us that where we see the forecast being for below normal, this is where we can believe the forecast, and it's not very optimistic. It shows drought. Now, is this an agreement, the forecast produced by other centers? Those are the two maps on the right. These are forecasts also produced for during the month of July, but for November, December, January, and October, November, December, and especially for the November, December, January season. This is a season that we don't yet make forecasts for. Our University of Pretoria effort will only make the November, December, January forecast in August, but you can see already strong indication that there's enhanced probabilities of dry conditions in association with the anticipated El Nino to develop that will become a moderate to strong event. This is the end of my talk. I apologize for the mishaps in the beginning. I'm sure the fault lies on my side. And I'm so glad that the technical people on your end fixed the embarrassment. And I was able to give my talk, and I hope I didn't go for too long.
Prof, no, I read a quote that says, the problem with troubleshooting is that the troubleshoots back. And I think today was one of those glitches that was just out of everybody's hands. So thank you very much for this insightful presentation. I think it gave us good insight about what we can expect. Next, welcome Andre Ferreira, who is the Regional Manager of Santam Structured Insurance. Andre is a deal maker for Santam Structured Insurance since 2016, and I think a lot of people in the financial industry are well known with Andre. He holds a BCom degree from the University of Stellenbosch, an ILPA from the University of the Orange Free State, and has been involved in the financial services industry since 1996. Andre is obsessed in helping business owners to find a practical solution to many and frequently challenging risks that they face. The current economy, regulatory environment, and climate change poses challenges to business managers to find risk mitigation measures for perils that was previously unthinkable. He is a specialist working with an executive team using alternative risk transfer methods to create insurance solutions where conventional insurance cannot meet the needs of business. Andre has successfully established alternative risk transfer as a viable and practical insurance option for agriculture and other industries that face unpredictable and changing risks. Andre is an overlanding enthusiast that enjoys spending time exploring Southern Africa with his family and friends, and he's also a keen golfer. Andre will present on the fundamentals of self-insurance against the backdrop of the discussion that Prof. Landman will give us when he returns, when he's online again. So Andre, the floor is yours. Will you please switch on your camera and then share your presentation with the floor?
Okay, Santam Structured Insurance is part of the Santam Group, and we fall under the Santam Specialist Division because we specialize in a product that is part of the alternative risk transfer market. Now, alternative risk transfer is named that way because it is an alternative to conventional insurance, where conventional insurance, as we all understand it, works in the manner that you pay a certain premium for a peril. Let's say the peril is R1 million. and your premium to cover that peril will be R1,000. And the conventional approach is that if you don't have a insurable event, the insurer will retain that R1,000 premium that you pay. In our case, it works quite different in the sense that you as the client contribute a premium that covers most of the peril, and we will issue you an insurance contract for that premium contribution. The insurer will also take part in the risk transfer up to 25%. But the big difference is that after the policy has reached its maturity date or expiry date, us as Santam Structured Insurance will share a large part of that underwriting profit to the owner of the back to the owner of the contract. So there's a much bigger emphasis placed on the insured, and I mean the client, which is in this case mostly for the farmer. So he will take part in the risk sharing along with the insurer, but as a reward for doing that, you will share in the profits of that insurance contract once it reaches its maturity date. So we as Santam Structured Insurance, we are an industry innovator in specializing in this type of insurance structuring that differs vastly from conventional insurance. Now, as you can see from this slide we're looking at now, consumer trends have changed, and the risks and perils that faces consumers have changed vastly over the last few years. And in this presentation, we're obviously focusing on the climatic and environmental risks, which is shown in the top right quadrant of this model. So, and based on these changes in the insurance industry, it has become necessary for insurers to offer different products to clients because of the different needs. And we especially see this in the agricultural market, where insurers over time have withdrawn some of the perils that they cover and benefits that they offer. And for that reason, it leaves those clients exposed to those perils with a very challenging scenario of making alternative plans to protect them whenever these type of risks occur. And this will be especially applicable when it comes to climatic and environmental risks. So based on the nature of our product, the client then can actually build up his own insurance capacity within an insurance contract, because as time goes by, he can contribute premiums towards this insurance policy. Those premiums build up in that insurance policy, and over time, the client will have an insurance contract that will help him to overcome very difficult times. Now, if we look at just go a little bit forward in the slide, we will get to the next slide, please. So we will get to an example of how it actually will work in practice. So the typical client who would look at a policy like this is somebody that is willing and has the capacity to share risk with the insurer in a much bigger way than normally. Obviously, for him to make contributions towards such a policy and build this insurance contract, he would have to have sound and healthy cash flow in his business. And obviously, if a client would want to go this route, he must have excellent risk management in his business. So his loss ratio must be on the low side, because typically we see in the agricultural industry, those are also the clients that would tend to look at better value for money alternatives. Is there a question now? Okay, so the whole
Okay,
idea is
Nelly,
then
daar
over
was
the
twee Willem Landman aanlyn.
the whole idea would be to build up insurance capacity over the long term in a short-term insurance contract. And this would serve as a protection for that client. Clients that have cyclical businesses, typically in the agricultural space, they are very well suited to this type of product because you would typically have years where you have excellent financial results, followed by years where you have not such good results, and those years where you have excellent financial performance would be the years that would allow you to contribute towards an insurance contract like this. Now, if we just look at this little example that we've made here, in this case, this client's risk that he wanted to insure was a figure of 10 million rand. And after he decided to go the multi-peril policy route, he decided to contribute a premium of 1 million rand for that financial year. Now, when the premium of 1 million is paid to Santam Structured, we will issue him an insurance contract for 1.25 million rand indemnity. That is the figure below the 10 million rand. So it's very important to note that although his risk is 10 million, he only at that stage will have cover up to 1.25 million rand because he made a contribution of 1 million rand. Obviously, we take fees from that. That is the underwriting charge of 50,000 rand. So his premium, his policy value will start with us at 950,000 rand. And just to illustrate how the policy works, this client had a claim of 200,000 rand in that year. So that comes off the 950, which will leave him with an underwriting result of 750,000 rand for that financial year. Like all insurance companies, we invest those funds and we share the return on that investment with the client. So that 59,000 rand will be added to the underwriting result, which gives us a result of 809,000 rand. And that amount can be declared as a risk management discretionary bonus to the client. And the client at that stage will have the option of saying to us, please, I don't want to continue with this contract, and then we will pay out the 809,000 rand to him. Or he can say to us, we want you to continue with the 809,000 rand as the rollover premium for the following year. And the following year, he will then start off with a balance of 809,000 rand in his contract, and he can then decide if he wants to make another contribution or not. That is totally up to the client's discretion and financial and his financial ability if he wants to do that. So you will see, if we can get to the next slide, you will see that over time he will build up a reserve in this contract like this. And if a peril would happen, he will then claim from this contract. So the idea for this client would be to build up his funds so that he gets to the 10 million rand eventually. Now, this is just a comparison. So the blue blocks is an illustration of how the funds will build up if you would have done this in your own capacity, in your own bank account, versus doing this in a policy like ours. And the big difference comes in because this is an insurance contract. All the premiums paid to this policy is treated like the premiums that you would pay to a normal insurance contract in your income statement. So there's a benefit in that, as well as the 25% additional cover that SSI gives the client on top. So all of that, if you take that over time, will build up this fund quicker than you would have done in your own capacity and had done it with after-tax funds. Okay, just if we go to the next slide. So the first question we get from our clients is how do we access those funds if required? Obviously, you have an insurance claim based on the perils that you insured, and because most of the risk is carried by the client himself, the underwriting process is vastly different and much simpler than with a conventional insurance policy, and we normally pay those claims within 24 hours. You can also endorse a contract like this, so you can increase or decrease the amount of cover at any stage during the contract. You can change the risk perils that you want to insure or the cover limits, and that can be done at any point during the contract. The next way of access of using this policy to access funds and help your liquidity in the business, if we can go to the next slide, would be to make use of an access facility, because as you can understand, this policy has value, and we as Santam know that you can see this as surety for a loan at a bank or even with us. So if you decide to make use of this facility, you can borrow up to 90% of the loan of the policy value in a separate arm's length loan agreement, and it's very simple capital repayments with the requirement that you only have to service the interest on a monthly basis, and there's no other surety required for a loan like this except the surety of the policy. That basically is how the loans work. And just to illustrate it, let's say on the left-hand column you have a policy that's worth R1 million, and there's a loan of 700,000 against it. You will still receive a profit share on the R1 million at its current rate of 7%, while on the loan you will pay interest of prime -1. So if you go and do your calculations, you will see that this is a very attractive option for our clients, and about 60% of our clients do make use of this because there are no administration costs involved with these loans, and it's a very simple transaction, especially if we consider the amount of effort that it is to secure a loan at a bank or a different financial institution. So that's why the loan facility is a very popular option for our clients. And just to summarize what we've talked about, our policy is part of the alternative risk transfer market, and we offer tailor-made solutions covering a wide range of risks where conventional insurers would not be inclined to look at those risks. You can buy a policy like this or use it in combination with your conventional insurance, and especially with Agri insurance, you can use it where it comes to crop insurance, where you might increase your co-payments or your first losses with your conventional insurer, and then insure those first losses through a program like this. You can obviously use this to optimize your insurance and create further capacity and reduce your reliability on conventional insurance over the long term. So, and obviously, it's a big reward for those businesses that maintain and have very good risk management processes in place. So we do have representation over the whole country. I'm in the Cape Town, Eastern Cape and Northern Cape area that I serve. Jaco Fourie is my colleague that is in the Boland and Southern Cape area. Gert Olivier is my other colleague that's in the northern part of the country. And Vincent operates in Gauteng and Natal. And the contact details are here. And you're most welcome to contact any of us should you want to discuss our offering further, or maybe just want to set up a meeting with a client. Obviously, we assist where we can. So thank you very much. I'm not sure if there are questions, but please contact us if you have questions I'm I'm not sure how long this link will last further and what the time is doing. So thank you very much for the opportunity.
I would want to ask, please ask any questions in the chat box that we will quickly answer afterwards, or Prof, as well as in all your questions in the chat box. Andre, I want to just ask you quickly, just looking at the presentation by Prof. Landman, just linking with what you have discussed earlier, if you can just summarize in a sentence or two. Thanks.
Thanks, Andrea. Well, I think the presentation by Prof. Landman just emphasizes how volatile situations can be and how quickly conditions can change. And I think it just makes it more important for farmers and everybody in the agri space to think about those type of risks and think about how they're going to prepare themselves, because I think our product gives them the opportunity and the vehicle where they can preempt certain situations and make financial provision for that in a way that makes financial sense to them as well. And I think our product is extremely suitable for that, based on the different approach that we have to underwriting and the cost of it. So I think that is a valuable bit of information to take out of this important information about climate change that we're seeing.
Thank you very much, Andre and Prof. Landman. I think just for our last speaker, we have Willem Symington from Agri SA. Willem will speak to us specifically on his experience as a farmer and how he has overcome many obstacles. And I think he will also give us a bit of a closing remarks on what was discussed today. Just to introduce Willem, he completed his BSc degree in agriculture at the University of Stellenbosch in 1989. Thereafter, he completed his BSc honours degree with a distinction at the Stellenbosch University in 1990. Willem has became a farmer after his studies and is currently farms in Williston in the Northern Cape with Dorper sheep. Willem joined Organised Agriculture in 1990 and is currently the Vice President for Agri Northern Cape. He's also the chairperson for Agri SA's Natural Resources Centre of Excellence and the vice chairperson for Agri SA's Disaster Relief Foundation. So Willem, I will give you the floor as our last speaker for the last few minutes. If we are not going to be able to get to the questions, we will circulate it afterwards, but the floor is yours. Thank you.
Thank you, Andrea. It's such a privilege to be part of this webinar and the information that was shared here today. Maybe I should just start off to say that it's greatly encouraged me that the private sector and the agricultural sector, as well as the academic part of our society, makes such an effort to try to understand the influence of weather on the agricultural industry in South Africa better, and to make an effort to enhance the sustainability and the profitability of the agricultural sector. Maybe I should just start off with a few experiences that I've been part of as a member of Organised Agricultural, as well as a bit of a farmer during this last 10 years. I think that this isn't the first time that we in South Africa has had periods of drought and severe drought as we've had, especially since 2016 and 2019 and 2020 in some parts of our country. But I do think I can boldly state that this was the period where agriculture received the least amount of aid or support from our government side in our history as a country. This opens up a whole new box of challenges for the agricultural sector, especially in the animal side of production. farmers over the last 50 years have grown accustomed to government providing safety nets during periods of severe drought that had significant economic impacts on their farming activities. I think we can safely say that this time has gone past. We will never receive from government side the aid or sufficient aid to sustain farmers during periods of drought that causes drastic financial implications for them. Therefore, it heartens me to see that there is a definitive drive from other role players in our economy to make it possible for the agricultural industry to continue to produce food on a sustainable basis. I foresee that the kind of models that Santam is busy rolling out will have to be even more greatly enhanced and be made sector specific for the different kinds of farming activities that farmers practice in South Africa. I don't think that the model that will work for maize producers will be the same one that can be used for stock farmers. Then we've got the table grape and the export grape and the raisin sectors and the different fruit sectors. I do think there's enough money involved in all of these sectors to make it viable for organizations such as Santam to come up with these schemes and these plans so that they can make some money out of it as well, but provide opportunities for farmers to make their farming enterprises more secure. I think everybody will agree with Prof. Landman that predicting the weather is not an easy task. I want to commend him with the work already done, and I do share with him the need and the desire to greatly enhance the accuracy of the predictions that we can make. One of the worst things in having risk and trying to mitigate the risk is in working with information that is not suitable or clear enough or enough information to make really good decisions going forward. I do hope that technology and the amount of work that is being put into this field will make sure that we can make even better predictions with better outcomes than we already can do. Andrea, from organized agricultural side, I think we can clearly state that it is a huge privilege to have partners outside, like Santam and like Prof. Willem, willing to do this kind of work. And from our side, we will assist and provide any help that is needed for them to make these contributions. I would like to thank everybody that took the time this morning to attend this webinar. I do think the figures that attend this webinar clearly spells out to us the importance that people see in providing this kind of information to the agricultural sector. Andrea, I think that is enough from my side. If there's anything that you want me to add or to elaborate on, feel free.
Thank you very much, Willem. Now I think you have concluded very nicely. I want to just thank the attendees today for your patience and also listening in. It was very insightful. and it gave us new understanding of what can we expect and how we can deal with risk going into the future. Thank you to Santam, Prof. Willem Symington as well. Yeah, I'm going to formally close the meeting at this stage. All the questions have been answered in the chat box by the attendees, and have a great day. And the questions and the recordings will be made available as well as the CPD certificates. Thank you.